Okay, students, the last video I was explaining this exercise 11.3 and time ran out on me and I just kept explaining away and probably 3 or 4 minutes went by before I realized the tape had stopped or the recording had stopped. So I will go back and explain this again. I also apologize I didn't read the problem carefully enough, prepare the stockholders equity section of the balance sheet. I was looking at it and expecting to see a statement of stockholders' equity, and I hadn't read the problem carefully enough. So, um, stockholders' equity section of the balance sheet. So, what are we going to have? Well, we're going to have all the stockholders' equity accounts just listed in total. So, for common stock, and I'll just start over with this explanation. But with common stock, we had 40,000 shares issued at 15 and 3,000 shares issued at 20. So that's 43,000 shares. So common stock, we're going to show 43,000 shares at $43,000. Now preferred stock, and they list preferred stock first, so I should have started with that, but we issued 10,000 shares at 16 and then another 1,000 shares also at 16. So we have 11,000 shares of preferred stock issued, 10,000 shares here and 1,000 shares there. Par value is $10 per share, par. So 11,000 shares times $10 par is going to give us preferred stock at $110,000. Now, we sold the stock at $16 per share, both occasions. $16 per share here, $16 per share here. So we had additional paid-in capital, or it's sometimes called paid-in capital in excess of par value, but additional paid-in capital of $6 per share. Again, the $6 being the sale price, $16 per share, minus par value of $10 per share. So $6 per share times 11,000 shares, 10,000 here, 1,000 there, is going to be $66,000 in additional paid-in capital on preferred stock. Now the common stock, we talked about that a few minutes ago, and that was 43,000 shares issued at $1 par. So that's going to be $43,000. Now the additional paid-in capital on the common stock came from the two sales. So we had one sale of 40,000 shares at $15 per share. So par was $1. So additional paid-in capital was $14 per share times 40,000 shares. And then here we issued an additional 3,000 shares at $20 per share. So $19 per share additional paid-in capital on common stock here. We're going to add those two together to get the total additional paid-in capital on common stock, and that's calculated down here. There's the $15 per share selling price minus the $1 par times 40,000 shares plus $20 selling price per share minus $1 par times the 3,000 shares that were sold at 20 gives us the $617,000 in additional paid-in capital on common stock. Now, there's nothing wrong with presenting it this way, but to be honest, there's really no reason for two additional paid-in capital accounts. Really doesn't matter how much additional paid-in capital came from preferred stock, how much from common stock. You could easily just combine both of those together and show one additional paid-in capital account. So we add all of these together, the preferred stock, the additional paid-in capital on preferred, the common stock, and the additional paid-in capital on the common stock, and that gives us total contributed capital. Now remember, there were two categories of capital. One is contributed capital, the other is earned capital. So under earned capital goes retained earnings. So we need to go back to the question and see that they showed net income for the first year of $48,000 and no dividends were declared. So that $48,000 of net income is going to get close to retained earnings with no dividends. So there's our $48,000 of retained earnings. Total stockholders' equity then of $884,000. Okay, now let's go back to the textbook. Earnings per share, sometimes referred to as EPS, but that is, from an accounting standpoint, one of the more important numbers that you see. It's shown on the income statement below net income. And in the advanced accounting classes, you will learn that there are actually some a little more complicated situations where you get into, I didn't really talk about convertible preferred stock, but preferred stock is sometimes convertible to common stock, or you get into convertible bonds that can be converted to common stock. Then you get into what's called dilution of common stock, but we're not going to deal with that in this class. So in its most basic form, earnings per share is just net income minus preferred dividends, because that is net income that's not available to the common stockholders to be paid as potentially a dividend. So net income minus preferred dividends divided by the average number of common shares outstanding gives us one number, earnings per share. Kind of shows how much net income was there per share of common stock, the income that was available to the common stockholders. Now, you also see here return on equity, commonly referred to as ROE, and there we take, again, net income minus preferred dividends and divide it by the average common stockholders' equity. So we are then calculating how good of a job did you do at using the common stockholders' money to make income for them. Okay, and the higher the better, obviously, as with earnings per share. And by the way, these numbers can be, especially earnings per share, can only be compared from one company from one year to the next. Comparing two different companies, kind of meaningless because their capital structures may be entirely different. Their stock may be selling at different prices, may be different numbers of shares of stock per dollar of equity. It's meaningful comparing one company from one year to the next, but not comparing two different companies. Return on equity, again, it is meaningful to compare from one company to the next. And then finally we get in here to what's commonly referred to as the PE ratio, or price earnings ratio, and that's taking the current stock price divided by earnings per share. Now, that one's interesting. It comes out a multiple, and that really gives you a measure of what the market thinks of the future prospects for a company. So the higher the number, the more upside the market views that company is having. So a company that's in a really good market position, or a company that the market really respects their management, will have a higher PE ratio, or price earnings ratio. A company that's in decline will have a much lower price earnings ratio. Okay, and your book then explains about these ratios. And we get to owner's equity for other forms of business, sole proprietorships. For example, instead of common stock and conditional paid-in capital, we have the owner's capital account. And then instead of dividends, they have a drawing or withdrawal account. So the proprietor takes out money that goes through their withdrawal or drawing account. And whatever their capital that they have in the business is their capital account. Now for partnerships, each partner actually has a capital account and a drawing account or withdrawals account. Now partnerships, two things I'll tell you about partnerships. Number one is if you ever get involved in a partnership, make sure you have a formal written partnership agreement. And then the second thing I'll tell you is never get involved in a partnership. It is you will find out if you have a good friend and you go into partnership with them, most likely what you're going to do is ruin a friendship. So not many partnerships survive real well. Now you see I have written out here Frankie Valli and Bob Gaudio. They're an exception. You may have heard of Frankie Valli. If you want to hear some good music, go to YouTube and search for Frankie Valli and the Four Seasons and some great music. But they were two members of the Four Seasons, and they formed a partnership that has lasted for like 50 years on just a handshake. That is the rare exception, not the rule. So never get involved in a partnership is my advice. If you want to go into business with a friend, then form an LLC or an LLP. Okay, and they talk about LLPs and LLCs down here. And recording stock dividends, I've talked about those already. Large stock dividends, remember, are recorded at par. And they talk about that 20 to 25%. And again, that's a guideline, not a bright line. But you don't see many stock dividends in that 20 to 25% range. For a large stock dividend, it's accounted for at par, so you strictly debit retained earnings, credit common stock, and that's kind of the shortened version. Usually go through common stock distributable and then debit dividends, credit common stock distributable, then you debit common stock distributable and credit common stock when you issue it. And then in a closing entry, you close stock dividends to retained earnings. They've just kind of cut out all that. And down here with small stock dividends, they're accounted for at market price. So there's usually some additional paid-in capital involved. Okay, that gets us through this chapter, chapter 11, and covers all the material we have for the semester. So I will be sending you emails about what to expect on the third exam and on the final exam. Remember, the final is cumulative. So third exam, I'm giving an exam in my intermediate class, and it's all problems, no multiple choice. I may do the same with you guys. I'm still deciding. But anyway, I'll let you know well ahead of the exam. Don't forget, the exam is coming up May 5th, I believe it is. It's a Monday. You can check the syllabus for the date. And in fact, let me come over here and just pull up the syllabus. And let's see, right there is the revised syllabus. And it's opening, and come down here and view and zoom, and we'll go to 120%. Then I'll get it where you can see all of it. And third exam May 4th. And the final exam will be on Saturday, 1 to 3 p.m. Now, this exam will be during your normal class time. The final exam will be on Saturday, May 9th, and it will be comprehensive. All right, I'll end this one now, and good luck to each of you.